So I'd like us to start. So I'm going to make some brief introductory remarks and give you a run through of what is expected of you during this webinar. So my name is Alex Wawero. I'm a program officer at LSK Nairobi branch and in charge of the tax liaison committee. I'd like to recognize the presence of some of the committee members led by the convener, Mr. Stephen Saini. I can see co-conveners Gitao Komu and Janet Labuna in the meeting as well. And so this is the second tax awareness forum that we're hosting. The first one was facilitated by one of our co-conveners, Ms. Janet Labuna, and we hope to hold more in the coming weeks. Today's webinar will be facilitated by a tax team from Anjarwalla Khanna Advocates, led by one of our co-conveners, Ms. Wangoi Mwaniki. And before we begin, let me just go over some ground rules. Please keep your microphone muted unless you've been requested to speak. And also, you can field your questions in the chat box so that the facilitators can see the questions, and then we'll be able to answer them at the end of the webinar. And so, without further ado, let me welcome Ms. Wangoi Mwaniki to take over at this point.
Good afternoon, colleagues, and let me take this opportunity to welcome you to the second session of the tax series of trainings that's being conducted by the LSK Nairobi branch. And today we'll be speaking about or taking members through the salient features that we see coming out through the Finance Bill 2021. By way of introduction, my name is Wangoi Mwaniki. I work as off-counsel in the tax team at A&K. And for today's session, I'll be joined by my colleagues. And without much ado, and before we get into the session, I'll ask my colleagues to introduce themselves. And we start off with Wangoi Karuga. Thank you.
Good afternoon, everyone. My name is Wangoi Karuga, a principal associate within the tax team at Anjarwalla Khanna. Nice to have you this afternoon.
Good afternoon, everyone. My name is Dennis Chiruba, a principal associate with Anjarwalla. Good to have you today.
So good afternoon. I believe we can all see the slides on the screen. Can I have somebody just confirm that for us? You can see the slides?
Yes, we can.
Alex, are you able to see the slides?
Yes, I am. Yes, I am.
Okay, thank you very much. So as a start, we'll just begin by setting the scene for our presentation today. And this is, the scope of our presentation. So, we'll just set the scene and, look at what is happening behind the scenes that's leading to a lot of these legislative changes and the aggression, obviously, that we are then seeing from our colleagues and from the Revenue Authority in terms of collection. And then after that, we'll then get and have a look at the salient features that are coming through the Finance Bill 2021. So we look at the changes coming through the Income Tax, the Value Added Tax Act, the Excise Duty Act, the Tax Procedures Act, and then finally we look at the Miscellaneous Fees and Levies Act and the changes proposed therein. So by way of setting the scene, what we've seen is, why are we seeing, a lot of legislative changes coming through, either through the Finance Bill, through the Tax Laws Amendment Act, or through the Business Laws Amendment Act. And we are seeing a lot of tax legislation changing, very, very frequently. We are also witnessing, a lot of aggression from the Revenue Authority, in terms of enforcement and collection. And some of this is being driven by, what we call an overview, or the state of the economy as it is today. And what we are seeing is that obviously over the last few years, there's been a steady decline in the government revenue as a share of GDP and investments that we are seeing the government rolling out. Secondly, we are also seeing a growing reliance of non-concessional borrowing, which has contributed, of course, to increase to the current borrowing from the IMF by our government, and the kind of reactions we have seen come out of that. We've also seen the reduced economic activity and increased pressures push Kenya into high risk of debt distress. And obviously this has not been made easy, with the COVID pandemic that, as a country and globally that has been witnessed in the last year or so. And obviously we will continue to suffer in we have then seen, before we get into the finance Bill 2021, is that we saw, last year through the Finance Act 2020, the introduction of minimum tax. And what this means is that, even companies who are in a loss-making position, through the introduction of minimum tax, will be required to pay 1% of their gross turnover every quarter, whether or not, you're then making a profit or not. And so these are some of the measures that the government is continuing to introduce to sort of try then and boost collection. But I think without much ado, I'll then invite my colleague Wangoi Karuga to then start us off on some of the changes we expect to see from the finance bill currently. Thank you very much, and I will be speaking to you later in our session today.
Thank you, Wangoi, for that background. And just to give you a general overview of the changes in the corporation tax as introduced by the Finance Bill 2021, most of the changes we note are as a result of the raft of legislative changes that took effect in 2020, including the Finance Bill and the Tax Laws Amendment Act. So as a result of those changes in the Act, there were certain introductions and deletions and amendments that were introduced in 2020, and the Finance Bill 2021 seeks to clarify, provide additional information, do some cleanup exercises here and there following the changes introduced by the Finance Bill and the Tax Laws, the Finance Act and the Tax Laws Amendment Act of 2020. We also note there are a raft of changes that seek to target multinational entities operating in Kenya, and this has largely been occasioned by Kenyans' interest to comply with international best practice and also to comply with the BEPS action plans. So we will note from our discussion this afternoon of the various key changes that will greatly impact multinational enterprises and headquarters of multinational companies that carry out business in Kenya. So just to start us off, I will take you through various proposals in the income proposal by the Finance Bill to the Income Tax Act. Most of these proposals are intended to commence by 1st of July of 2021 and others by 1st of January of 2022. And then my colleague Dennis and George will also take you through the additional changes in the Income Tax Act. So to start us off, we will consider the proposed changes under the thin capitalization restrictions. So currently in Kenya, companies are allowed to finance operations through either debt or equity. And where you choose debt financing, then thin capitalization rules or restrictions come into place. So what thin cap seeks to do is to limit the deductibility of interest, especially by foreign-controlled companies in Kenya. So generally, when you borrow money or you finance through debt, then the interest expense incurred is allowable. But there are provisions in the Income Tax Act that restrict the deductibility of this interest for companies that are foreign-controlled, and also that exempt the application of thin capitalization to financial institutions and banks and financial institutions listed in the schedule of the ITA. So the current ratio for thin capitalization is a ratio basis of debt to equity of 3:1 and 2:1 for players in the extractive sector. So where you are your debt ratio exceeds 3 times your equity ratio, then you are not allowed to take a full deduction of the interest expense incurred in debt funding. However, we note that the bill proposes to change this computation to a more stringent and punitive basis known as the Ebitda basis. So this has been proposed by the OECD, and we note that various countries have actually adopted it. The UK, the US, Canada, and closer home, Uganda, apply the Ebitda basis. So how Ebitda is computed is you consider your earnings before interest, tax, depreciation, and amortization. So basically, if you have your tax computation, for instance, you will consider your profit before tax, and then onto it, you add back your interest, and then you add back this notional, loss of value of your assets, which is depreciation or amortization, to arrive at the Ebitda. And then further, the bill also proposes that once you consider you get that Ebitda, you further exclude income which is exempt from tax from those earnings. So I don't know, income from infrastructure bonds, for instance, if you are earning income from infrastructure bonds, which are exempt from tax, you exempt it from computation of Ebitda. And then now you take 30% of that figure. Is higher than 30% earnings and Ebitda, any excess of that 30% of that value is restricted, is not allowed as a deductible expenses. So we note that this is very punitive because it's highly likely that in most cases your interest payments will be higher than the 30% of Ebitda. And then we note that the finance bill also proposes to extend what is deemed as interest on loans to include payments that are economically equivalent to interest and also expenses that are incurred in connection of raising finance. So this is a new addition because at the moment, say, I don't know, appraisal fees or approval fees for loan for raising funds or even are not considered as part of the interest, or anything that they say is economically equivalent as interest is not considered as part of the interest. So we have broadened the definition of interest for thin capitalization basis, and this will result to a higher amount being restricted or being disallowed, leading to a higher payment of tax. Next slide. So we note as this provision is covered under section 16.2J of the ITA that provides for disallowed expenses. So as currently worded, banks and financial institutions are excluded from, licensed financial institutions are excluded from thin capitalization rules under section 16.2J. It also excludes, it also just applies to entities that are foreign controlled. So with the proposal from the bill to delete that section and to replace it with a new section, those two exclusions or provisions are repealed, to the sense that now going forward, banks and financial institutions under the bill are subject to thin cap, and also resident companies would be subject to thin cap. So this will adversely affect companies that rely on debt funding. For instance, startups that are raising funds to begin operations, or real estate firms that are heavily geared by debt funding, and even entities in the extractive industry, which are heavily funded by debt as a source of capital. So it will adversely affect those sectors. And for extractive industry is very interesting because the ratio was even 2:1. That has now been removed and totally covered under the Ebitda basis. So it will adversely affect the extent of interest that can be allowed. So as mentioned, we see this applies in other countries, and closer home Uganda takes the same position. But what we've seen interesting about Uganda is the provision of foreign control is applicable. That thin cap only applies to companies that are foreign controlled. As the bill is currently worded, there is no provision for foreign control. So thin cap now applies to resident companies, and we are yet to see how that will, pan out with the Finance Act coming in place later in June. So we are aware of various lobbying initiatives to to repeal or to do away with this Ebitda basis of thin capitalization and maybe to revert back to the ratio basis, but it's a wait and see. Yeah, so over and above thin cap, then we have DST. So DST is interesting because it was first introduced in Finance Act 2019 that sought to bring to tax and also to VAT any income that has been earned or accrued from a digital marketplace. Then in 2020, the rate was clarified that DST will apply at 1.5% on the gross transactional value of income earned by non-resident entities and making supplies through electronic means or through a digital marketplace in Kenya. The challenge that we saw with DST from both an income tax perspective and a VAT perspective is the coming into force of the regulations that came into place around September and November last year for income tax and for VAT. So what we call the DST regulations under the income tax and the digital market supply under the VAT Act. So both regulations sought to clarify the nature of digital services that would have been subject to DST and income tax and also VAT. However, we noted a couple of interpretation issues and a couple of lack of clarity as to what exactly were digital services. So what the finance bill proposes this year is to sort of provide guidance and clarity of what exactly is a digital marketplace by providing clearer definition. So there's a proposal to expand the DST definition, the DST ambit, to include income accrued from a business carried out through internet or electronic network. This proposal has largely been occasioned by the different interpretation of who exactly is a digital marketplace supplier, who exactly is carrying out digital services, and who is earning income from providing a digital platform. And now, if this proposal comes into law, then any business carrying out business through the internet or electronic network will be deemed to be subject to DST. So that really widens it to include even companies like betting companies who bet through, through their website, which was not a digital marketplace because there's no really supplier and there's no consumer. It's just a website that I own, that I provide services, or they were not really categorized under a digital platform. So this would net a lot of players to DST. And another interesting clarity is the definition of digital marketplace. So this has been defined to mean an online platform that enables the users to sell or provide services or goods or property to other users. So a digital marketplace now is an online platform that will enable one to sell any sort of services. So whether you are providing a platform for someone to sell services or goods, then you'll be deemed as a digital marketplace. It is interesting to also note that DST has been expressly now excluded for resident persons. Initially, DST was applicable to both resident and non-resident entities carrying out supplies or earning income through a digital marketplace. And then for resident persons, the DST was treated as an advanced tax, while for non-resident persons, the DST was a final tax. So there was a lot of outcry for resident persons who would then be subject to, corporation tax, and in some instances also minimum tax. So this is a welcome move to expressly exclude resident persons, which ultimately was the intention of DST, to bring to tax non-resident people who don't have presence in Kenya, and yet they're still earning income from Kenya. So there's also additional clarification on what income is exempt from DST. So for withholding tax, this proposal was introduced in the income tax DST regulations to exempt income subject to withholding tax from DST. And of course, there was this confusion of you are seeking to amend a primary law that under section 35 of the ITA that subjects to certain payments to income tax, through a subsidiary law, which is the regulation. So by bringing the exemption from withholding tax to the Income Tax Act, then it sits in place, the correct place, and is a welcome clarification. So, for instance, people who are earning fees and commissions that are subject to DST because of offering services in a digital marketplace. So if such fees and commissions are subject to withholding tax, then the exemption provides clarity that such fees and commissions should also not be subject to DST, which is a welcome move. And then there's also the exemption of non-resident businesses who transmit messages via cable, radio, fiber, VSAT, and internet and satellite. So this exemption is good because such income earned by a non-resident person has a special category of taxation under the Income Tax Act and should not be subjected to DST under Section 12 of the Income Tax Act. So interesting to note also is the provision of carry forward of tax losses. So generally in Kenya, businesses are allowed to if you incur losses, tax losses in a given year, to carry it forward for up to a period of 10 years. And within those periods, if you are in any taxable position, then you are allowed to take a deduction of the tax losses against the tax payable, provided it is tax losses and taxes relating to the same source of business. So for instance, you can't deduct rental income from business income because those are incomes that are separately sourced. So, and with the provision to carry forward tax losses, again, if after 10 years your losses are not extinguished or they have not been fully deducted against the taxable pay, then the tax losses are lost on a first in, first out basis. So that's how it currently works. So we note that the bill has actually proposed to amend the act to allow taxpayers to carry forward losses indefinitely. Well, this is good because we notice even Uganda allows indefinite carried forward of losses, but we feel this change has been largely necessitated because of the introduction of minimum tax. And how minimum tax worked, as you all remember, it sought to subject every business, every person earning income in Kenya, except from the excluded people like employment income, rental income, turnover tax. So any other person who is not excluded from minimum tax to pay a minimum tax, essentially, of 1.5 of your monthly gross revenue. And there was a lot of outcry to minimum tax because this brought loss-making companies to tax. And we all know of the stay that was given by the High Court, and that being a matter currently in court, we will not discuss it in detail in this webinar, but then we note the reprieve that this indefinite carried forward of losses is intended to achieve. But it's interesting to note that even when we have indefinite carried forward of losses, in the coming into force of minimum tax, if and when, minimum tax cannot be offset against the tax losses. So it sort of becomes redundant, or you'll still be required to account for minimum tax even when you can carry forward losses indefinitely. Also, we will also discuss the changes, the drastic changes that we have seen with the definition of permanent establishment. So just to give a background or explain what a permanent establishment is. So a permanent establishment is okay. So a permanent so this is how a permanent establishment comes into place. So where an unresident person is carrying out business in Kenya, then and earning income, they will be deemed to have created a permanent establishment. So Kenya generally applies a source-based income tax regime. So for any income that has been earned or accrued in Kenya is subject to tax in Kenya, except employment income that you are required to pay employment income on worldwide employment income. So where a non-resident person carry out business in Kenya and earn business and earn income in Kenya, then that income is brought to tax through the source-based regime. But the practice has been there has to be a bit of threshold to determine when do you crystallize residence in Kenya, because residence in Kenya is as a result of either incorporation or where the commissioner gazettes you to be a resident in company, or even where your place of management is in Kenya. So for non-resident companies that earn income in Kenya and yet they have not crystallized, they have not registered as entities in Kenya, then the permanent establishment rules will apply to them. So with the proposed amendments, it is now easy and extremely easy to create a PE in Kenya. We will notice that once a PE is created, then the carrier will use transfer pricing principles to ascertain the income and the profit which will be attributable to the PE, especially if you're trading with an unresident person. And once you create a PE in Kenya, generally, after having met the conditions that we are going to look at shortly, your income will be subject to tax as an unresident person at 37.5. And that will trigger a registration requirement in Kenya, either as a subsidiary, an entity registered in Kenya, or a branch of your non-resident entity in Kenya. So currently, there are a raft of changes to do with permanent establishment, and we'll notice that these changes are highly inclined to the UN model of the definitions of PE. So as it is now, a permanent establishment is created through having a fixed place of business, what we call a fixed place PE. A fixed place of business where you are partly or carrying out business for a period of at least 6 or more months. And you will see in the slides, there are a couple of things we have listed that would crystallize a fixed place PE, like having a place of management, a branch, an office, a factory, a mine, an oil and gas well, and the likes would crystallize a PE if you've been here you've been carrying out a place of business, you've been carrying out business from that place for at least 6 months. However, the definition proposed to entirely delete that section and provide for a new section, which we have noted does not provide for the 6 months threshold. So it is now very easy to create a PE if you meet if you're carrying out business in Kenya through any of those listed activities. And we note this also include having a warehouse where business is providing storage facilities, or a farm, an agricultural or forestry plantation. So with the deletion of 6 months, then it is very interesting, because so long as you have a place where you're carrying out these activities in Kenya, you'll be deemed to create a PE. And with the advent of globalization and digitalization and most foreigners coming into Kenya, so where you're even carrying out a business for relatively shorter time, you might create a PE in Kenya. We also note that with reference to building site construction and assembly and installation projects, the period was 183 days. And there was this issue of, do these 183 days need to be continuous and consecutive within the 12-month calendar, or can they be in piecemeal? And now we note that the bill clarifies that even where these activities are done at least for a period of more than 30 days, those 30 days would aggregate to 183 days. So if you come, say, for a month in February, in August, in December, despite it being disjointed, you'd have created a PE if you are running a building site or a construction or an installation project. So for big capital projects, it is likely that even consultants and engineers who often come to Kenya to supervise would create a PE of their non-resident employers from their countries of origin. So we also note that the dependent agent PE definition has been retained in the ITA. And I think lastly, which is of great importance, is the introduction of carrying out services in Kenya to constitute a PE. So where what you call the concept of service. So where a company is carrying out consultancy services in Kenya through employees. So it's employees or other people who are contracted by the company in Kenya, then they would have created for a period of at least 91 days, they will create a PE in Kenya. So we note this is currently included in the UN model, which recommends 183 days, but Kenya has proposed quite a shorter period of 91 days. We also note that various DTAs provide for the concept of service PE, like the South African DTA, where you are carrying out business through consultancy services through employees or other personnel in a contracting state. So those are the new and revised definitions of PE in Kenya. And yeah, it's interesting to see how non-residents will be affected. I'll now invite my colleague Dennis to take you through additional changes in the Income Tax Act.
Thank you so much, Wangui, for the good introduction and the other key things that have been introduced through the Finance Bill 2021. So now I'll take you through various other concepts relating to international tax, and one of them is control. So from a corporate law and legal perspective, we understand control to mean where a person, or in this case, maybe a shareholder, has controlling shareholding in the company, in this case, 50% and 1 or 50 plus 1. But from a tax perspective, control is looked at from a different perspective, because control has various tax implications, which may bring various issues to a company that may be deemed to be controlled. Now, definition of control was there in the Income Tax Act, but it was deleted by the Finance Bill 2020 and the Tax Laws Amendment Act 2020. And at the moment, as we speak, there is no definition of the term control in the Income Tax Act. So the bill has proposed to introduce this, but now with various adjustments, which are very adverse, or I say huge impact on companies to be deemed as controlled by a person or is an non-resident. So under the current definition, the proposed definition, control has been defined to include a person who holds 20% of the voting rights of a company. Now, previously, the definition we had mentioned 25% voting rights. In this case, this means that this threshold has gone lower, meaning that it's easy to meet the control test if the proposed definition goes through than as it was previously. The other key new concept that have been introduced relates to control by virtue of indebtedness. So if you have a bank or any other shareholder or person who has given a loan of more than 70% of indebtedness of a company, then that company will be deemed to be under the control of that person. Some other key issues that we have seen relating to control include having control of the board of directors of a company. So if a person can be able to appoint 50% or more of the board of directors of a company, then that person will be deemed to have control over it. The other thing is on intellectual property. It's an interesting one because we have seen various companies in Kenya operating through IP rights that have been granted by, say, foreign entities. If that IP right grants you, the power or the right to manufacture and process goods, then that person will be deemed to have lots of influence or control over that entity, whereby without that intellectual property, then this company cannot be able to undertake business or provide any services. So these are very interesting criteria that are being introduced, and we're going to see various issues in terms of interpretation and various tax implications on how these will affect those companies that will be deemed to be controlled from a tax perspective. So the second last is purchases and supplies. So where a person supplies 90% of its supplies to a company, and that company, say, purchases 90% from any other third party or whichever party that in any independent business dealings, those people will be deemed to be, or this company will be deemed to be under the control of the supplier or the purchaser. Lastly, and which is very interesting, is any other relationship, dealing, or practice with another person where the commissioner may deem to constitute control. We see this as a very broad criteria whereby the commissioner can interpret any relationship, and therefore this opens up to new interpretations or new criteria that the commissioner may say that if you have met this additional thing, then we can deem you to be controlled by that other person. So in terms of the impact, is that the proposed definition is quite wide, and the threshold has been lowered greatly. And because of this, independent trading companies with independent relationships may be deemed to be under the control of another entity, even though in the real sense there is no aspect of control or there is no aspect of influence in the business of the Kenyan entity. So from a tax perspective, this affects transfer pricing requirements, whereby related parties or a party that is under the control of another, they're required to trade at or undertake business dealings at arm's length. And in this case, required to also develop and maintain a TP policy, transfer pricing policy. The second aspect is on deemed interest, meaning that if there are, say, any debt arrangements between the Kenyan company and the non-resident party who is deemed to be in control of the Kenyan company, and these debt arrangements involve interest-free or no interest is paid, then a deemed interest can be deemed on that arrangement and withholding tax payable to the Kenya Revenue Authority. So how deemed interest works is that if there is an interest-free loan that has been issued by a non-resident person who is now, in this case, in control of a Kenyan person, a deemed interest, meaning a notional interest of a rate that is usually issued and published by the Kenya Revenue Authority on a 3-month period of, say, between 6%, 7%, and 8%, may be deemed on that loan, and therefore withholding tax payable in respect of that deemed interest. And therefore, this is a leakage of revenue from the Kenyan entity because it cannot be able to take a deduction against that interest. Very interesting development in Kenya is in relation to country-by-country reporting requirements. This relates to international taxation and how various countries in the world have taken up transparency and taken measures to avoid base erosion and profit shifting to various jurisdictions. So there is a proposed introduction of country-by-country reporting for multinationals in Kenya. This means that parent entities who have, or companies in Kenya whose ultimate parent entities are based in Kenya, will be required to prepare and submit various financial statements for their group entities in various jurisdictions and present them to the Kenya Revenue Authority. Now, this will only apply to those entities that have the ultimate parent holding company in Kenya. So for example, entities that maybe have a branch in Kenya, but they are based in the US, they won't be required to comply with this requirement. So for example, we have various banks that have they are wholly owned and their holding companies that are based in Kenya, for example, Equity or I&M Bank. They have branches in Uganda, Tanzania, Rwanda. So these companies will be required to prepare and submit returns relating to the group activities to the Kenya Revenue Authority. So the kind of information required relates to the amount of revenue, the profit or loss before tax, income tax paid, accumulated earnings, etc., in relation to these other companies. And this requirement will not apply to all MNEs, but certain MNEs that have met certain threshold, which we expect to see in the regulations that we expect to be published soon. So all these processes relates to the OECD base erosion and profit shifting project, Action 13, on transfer pricing and country-by-country reporting. So Kenya is trying its best to join other world economies in being a jurisdiction that can be commended as transparent and a jurisdiction that does not in any way harbor any tax evasion mechanisms. So secondly, which is very interesting also, is the common reporting standards. Now, common reporting standards are proposed to be introduced under domestic law. So in layman terms, it refers to the requirement by financial institutions to report on bank accounts of foreign individuals who have bank accounts in Kenya to the Kenya Revenue Authority. And then the Kenya Revenue Authority will automatically report these accounts to the respective jurisdictions where these individuals are resident. So the purpose of this is to ensure that residents who are based in another country but have bank accounts in another, for purpose of, say, secrecy, etc., they'll be able to be revealed by reason of the common reporting standards. This has been developed through the OECD to tackle tax evasion and also improve tax transparency and compliance. And it's based on the Convention on Mutual Administrative Assistance in Tax Matters, which Kenya is a party. This convention was signed by Kenya on 8th February 2016, where Kenya became the 12th African country and 94th jurisdiction. And it was ratified last year, 22nd July. And as we speak, the convention is in force. But the key thing to note is that the common reporting standards obligations have not taken effect yet, because there's a next step that Kenya needs to take. But what we also note is that under the finance bill proposes that these provisions come into force from 1st July 2021. But since Kenya is required to give notice to the OECD Secretariat stating that it has complied and it has set out and implemented all laws relating to the implementation of the common reporting standards, and thereafter signed the CRS agreement, we don't see that Kenya will be able to meet this deadline of the finance bill deadline of 1st July. And therefore, you're going to see various regulations even coming up, and we expect this to be implemented, say, in the next year or so. So it's a very important development, which may have various implications on taxpayers, especially foreigners who have bank accounts in Kenya and Kenya residents who have bank accounts in other jurisdictions. So in terms of obligation to the financial institutions, if an institution does not provide the information, there's a penalty of 100,000 if the information is false. And for complete failure, there's a penalty of 1 million. So we expect to see, and this is more like an added obligation to financial institutions, and we expect to see these financial institutions, developing systems to collect the information that they require to submit in respect of this requirement. At this stage, I'd like to invite my colleague George to take us through the various capital deduction changes that have happened with the finance bill.
Thank you for that, Dennis. So we'll just go to the next step, which is on the capital deduction changes. And basically, capital deductions are allowances provided to taxpayers and investors in Kenya to just take a deduction against their taxable income for the investment they make. And there are various rates for various kinds of investments or capital expenditure. So in 2020, we saw the change, the repeal of the second schedule to the Income Tax Act, which provides for basically the legal basis for claiming capital deduction. And one of the major changes we saw in that repeal was introduction of reducing balance basis of capital deduction as the main basis for most of the deduction. And how reducing balance works is basically if, say, a capital allowance is provided as at 10% on a reducing balance basis. How this will work is that a taxpayer will be required to take a deduction of 10% in the first year, and then in the second year they'll take a deduction of another 10% on the amount left from the previous year. This results in a very long winding, and most of the time taxpayers are not able to make a full deduction of the capital allowance, as opposed to straight line basis where if it's 10%, this will be 10% per year over 10 years. So in 10 years, for a on straight line basis, assuming the allowance is 10%, in 10 years, the taxpayer will be able to have taken a full deduction. So this, what we're seeing in the finance bill is a proposal to, revert to more of straight line basis, which is more simpler and more advantageous to taxpayers. So this is definitely, a welcome introduction. The other change we're seeing in relation to capital deduction is relating to the definition of manufacture, which has now introduced off-grid electricity supply. The definition of manufacture is a really, a key term in the claiming of capital deduction, because most deductions are based on either building or assets for manufacture. So everything that is covered under manufacture in the second schedule then will qualify for certain investment deduction. So in the current definition in the Income Tax Act for manufacture, we have the supply, generation, transformation, distribution of electricity to the national grid. So basically, this covers investment in the for sale to Kenya Power and supply to the national grid. So the introduction now introduces also off-grid electricity, and this will encourage investment by taxpayers, in off-grid electricity, because this will also be part of manufacture and will also qualify for investment deduction. We also have a definition, an inclusion of definition of civil works. I think this is some of the things that have been introduced based on some of the things that were left out in the second schedule that was introduced last year. So again, to just cover the civil works that will be, included, qualify for investment deduction over and above, like a building. So this will include maybe roadworks, fences and all that. So there's a defined list of what this will cover, and this is just a cleanup to provide clarifications to deal with the gap that was introduced with the change last year. Moving on to some changes we've seen in the extractive industry. We've seen some changes in the withholding tax rates for some payments. The first one being withholding tax on service fee paid by a contractor to an unresident subcontractor. The current rate is around 5.625%, and this has gone up or will go up should this become low to 10% effective 1st July 2021. This is just seen as a an attempt to just increase tax revenue. We're also seeing a change again in the same sector that proposes to reduce the withholding tax on a service fee paid by a contractor to an unresident person from 12.5% to 10%. This is just to align with other sectors, really nothing much, but obviously a welcome move in that industry. We've also seen a change in capital allowances. So as I mentioned earlier, there was a change last year which introduced a new second schedule reducing most of the capital allowances available. So the current rate for mining operations, is 100%, and these are the kind of rates we had seen in the old second schedule. So what we see this change to be doing by reducing the investment the deduction in this case to 50% in the first year and 25% in the residual years is to just align the extractive industry with other sectors, to basically just reduce this in line with changes in other sectors. There's obviously the issue of thin cap. This has been covered before. So there's a special rate for the extractive industry of 2 to 1. So this has now been aligned to, is proposed to be aligned to 30% of Ebitda together to be the same with other sectors. Then the next issue we'd like to discuss is on the other changes in the ITA relating to the hiring of the tax rebates that was introduced in 2016. If you remember, at that time there was an introduction of a tax rebate for apprenticeship. where taxpayers who will hire more than 10 university graduates for a period of more than 6 months will be allowed a tax rebate of 50% of the salaries paid to these graduates. What we are seeing now is an expansion of these to cover more than just university graduates, to now include technical and vocational education institutions. And this is seen as encouraging more taxpayers to take this up. There's obviously the issue that this has not been taken up by very many taxpayers, because I think of some of the stringent rules introduced around this. And we hope that this is will encourage more taxpayers to take advantage of the rebate system. We also have a proposed change relating to NHIF contributions. Currently NHIF contributions are on a graduated scale based on salary to a maximum of 1,700 shillings per month. So what we are seeing here is because NHIF is mandatory, there's a proposal to introduce a tax relief for individuals who make NHIF contributions. This relief will be up to 15% of the premiums paid per month. It's a small amount. Given 15% of 1,700, which is the highest band, will be around 225 shillings. But it's still a welcome relief, because it might even it seems like it's aimed at encouraging more compliance with NHIF. So this, again, we know in terms of things like policy premiums paid for education, life and health, there's always an insurance relief for that. So it's just now to include part of the NHIF contributions to this. We'll now move on to some of the changes that we've seen from a value-added tax perspective. Basically, the first issue that we are seeing here is same as what was covered by Wangoi relating to digital services tax. There's just something, a change in the VAT Act to just align that definition to expand to provide that supplies over the internet or an electronic network, in addition to those made through digital marketplace, will also be subject to tax. So again, just expanding the scope of the taxation of the VAT on digital services. We've also seen a clarification, basically through a change in Section 17 of the Income Tax of the VAT Act. Section 17 covers the deductibility of input VAT, and the first change we've seen is to change, the reference to that specific section, because currently, looking at the VAT Act, any claim of input VAT can only be based on Section 17. So the small change just tries to expand this to also cover other provisions of the VAT Act, as well as the VAT regulations, and to try and not limit that to just Section 17. Again, we've also seen a change in the definition of the issue of acquisition of passenger cars or minibuses. So there's been various discussions and even disputes as to what is the meaning of the term acquisition, because currently the VAT Act provides that basically the input VAT incurred in the acquisition, and the question is what is acquisition? Does it cover leasing, purchasing, hiring? So this is just a cleanup to just provide that this the acquisition issue will now cover leasing and hiring. We're also just seeing another change relating to the issue of group VAT registration. There was a provision that had just provided that the Cabinet Secretary may provide through regulations for the registration of group companies as one registered person for VAT. This we have been expecting regulations, but this never came into force. And this will ideally ensure that if you're one group, you can have one VAT registration and claim input VAT together and all that. But this provision will be deleted and will now ensure that the CS does not even have power to do that anymore. The next issue we are seeing from a VAT perspective is the issue of the power of the minister or the cabinet secretary, relating to the issue of regulations. So we saw in the last few years, the VAT regulations were issued, and there was a bit of a challenge with that because, under the current VAT Act, there was an issue that any regulations would need to be tabled, issued by the CS will need to be tabled before Parliament for approval. And, so what this proposal now tries to say is that the CS will have power to issue regulations without necessarily having Parliament approving this. So we see this as a challenge because it goes against, even the provisions of the Instrument Act, which is that, in the tax world, we say it is taxable at 0%. And what this means for you to be zero rated is that you can claim for a tax refund for all the input VAT incurred if you're involved in the exportation of services. What we are seeing now is a proposal to change, to move this from exported services from zero rated to exempt. This again goes against the global standards and just the provisions. And what it means that now, if this provision becomes law, is that persons who are involved in the export of services will not be able to claim input VAT, and they'll actually be required to. Maybe you can move to the next slide, Dennis. Yeah, so they'll be required to, they'll be even required to restrict their input VAT. So this again will pose a challenge, and I think this is one of the issues that current lobby efforts and even the submissions that are currently being put forward to just ensure that this point is this is obviously dealt with before we see the Finance Act coming into force. We're also seeing some exemptions relating to the energy sector being reintroduced. And for this one, I'll welcome my colleague Dennis to just shed light on some of these things that we're seeing with regards to the energy sector.
Thank you, George. Changes in exemptions related to the energy sector is very interesting because last year we saw the Finance Bill 2020 and the Tax Laws Amendment Act 2020 bring us a sort of deletions on various exemptions that were available under the law in relation to VAT. And this included all or almost all exemptions relating to the energy sector. So I know, I mean, for those who have had a chance to deal with investors in the energy sector, they usually sign power purchase agreements with Kenya Power, and also the government provides letters of support in relation to the projects. And some of these agreements provide for commitment that if there's any change in law, then the government will indemnify the project company in respect of any additional costs that the project company will incur in respect of the change in law. And therefore, since these exemptions were deleted and some of these companies had already been granted the exemptions, it of course meant that the government was under duty to indemnify these power companies. But what we have seen is that lobby efforts have been put in place since these deletions were done in 2020. And it's a welcome move that some of these exemptions have been reintroduced. So one key exemption that captures some of these power projects is exemption in respect of taxable goods supplied to persons that had an agreement or contract with the government prior to 25th April 2020. So this is the date on which the Finance Bill or the Tax Laws Amendment Act came into force. This is meant to cover those companies that had already entered into agreements with the government by this date. And even though we are seeing the wording of this, the introduced exemption is that it talks about agreements or contracts with the government, but this should also include agreements with Kenya Power in respect of contracts that the government is in support through the letter of support. The second exemption is on specialized equipment for development and generation of solar and wind energy. We have seen various projects coming up, and this is to promote green energy through solar energy and wind energy, and some of them have already been commissioned, such as Kipeto. So it's a good move because it incentivizes these power companies to invest huge amounts of capital to ensure that we get the green energy we need for future generations. And the last one relates to equipment for using geothermal mining and prospecting and exploration. This also is in relation to the same power sector. Secondly, there have been various exemptions relating to the health sector. Since we are in the pandemic period, it's really important that the government supports various activities in the energy sector, and this is one of the moves. So exemptions of medical ventilators, physiotherapy accessories, diagnostic reagents, all this medical equipment are needed for purposes of ensuring that the effects of COVID-19 and other illness are ameliorated. Various other changes that have happened include exemption on transfer of assets into real estate investment trusts have been introduced. So just by way of background, this exemption was introduced in 2018, but deleted 2 years later. This was through the Tax Laws Amendment last year, when there were various deletions on exemptions. But really, since the government is one of the pillars that they want to encourage is investment in the real estate sector, this exemption has been introduced to ensure that it incentivizes and encourages investors in this sector. Other changes include VAT exemption on disposable plastic syringes, which has been seen as going against the public good, but we understand that there's some categories of plastic syringes which have been left. So we wait to see whether the National Treasury will approve this deletion, but we hope not, because at this point we expect that full support should be given to the health sector. Supply of ordinary bread has been proposed to be deleted, meaning that previously or currently it's zero rated, proposed to be charged to VAT at 16%, meaning that the price of bread will go high slightly due to the VAT element. And lastly, which George has talked about, is about the regulations where the Cabinet Secretary for National Treasury can amend regulations without tabling them in Parliament. So we are now going to talk briefly about the excise duty, and I'd like to invite my colleague Wangui Mwaniki to take us through.
Thank you very much, Wangui, George, and Dennis. And now I'll take you through some of the proposed changes that we're likely to see through in the Excise Duty Act 2015 that will be brought about by the Finance Act. And one of them is a relief for excise duty on bulk internet data purchased for resale. So for anybody who is in this space, you'll be able to offset the excise duty that you incur in purchasing internet data from the excise duty payable on resale to the final consumer. So this is sort of very similar to the input-output setup that you see under the VAT legislation. Secondly, there's a proposal to introduce the excise duty on imported and locally manufactured sugar, confectionery, and chocolate. So this proposal first came through the Finance Act of 2018. And I believe at this point, some of the industry players moved to court through a constitutional petition and were able to obtain a stay of implementation of that particular piece of legislation. And then subsequently, through the Finance Act 2019, we see, locally manufactured sugar, confectionery, and chocolate being exempted from excise duty. We believe this could have then been a reaction to the constitutional petition that had been filed by the industry players. Then there was an attempt last year through the Tax Laws Amendment Bill to introduce excise duty again, but this was rejected by Parliament. So again, we are seeing a new attempt to reintroduce excise duty on locally manufactured sugar and confectionery through the Finance Act 2020. Then again, we are then seeing again an attempt to reintroduce excise duty on betting, and this is specifically on the amount that is waged or staked by a punter. And again, our initial thought is that this is again a reaction to a recent decision of the Tax Appeals Tribunal that was given in 2019. And previously, what KRA had attempted to do was to impose, or rather the government had attempted to impose withholding tax on winnings, and in interpretation of the term winnings, they had attempted to also include the stake that is placed by the punter. The TAT was very categorical that the winnings did not include the amount staked. So we are then now trying perhaps to see an attempt to circumvent that decision on withholding tax by reintroducing excise duty at the rate of 20% on the amount waged or staked by a punter. Then another thing, and this will then affect financial institutions. And when we talk about reintroduction of excise duty on fees and commissions charged by financial institutions, these are usually defined by reference to the act that under which they are licensed or registered, and this then will mainly affect banks and insurance companies. And what we are seeing is that through the Finance Act 2020, the definition of what constitutes other fees was defined so as to exclude fees or commissions earned in respect of a loan. And what these fees include will be things like your interest, your loan appraisal fees, your administration fees, your mobilization fee. So for a long time, there's been an attempt to bring all these fees within the of excise duty. But then now what we are then seeing, there's an attempt to delete the exclusion, so that then, it will be other fees, but then the exclusion relating to loans has been expressly deleted. So the questions that begs to be answered is, at the time of implementation, will then there be a view because the fees and commission in respect of loans, due to the fact that they are not expressly excluded, does this then mean that they will be subject to excise duty? This has been an area of contention, I think, since the introduction of excise duty on other fees and commissions earned by financial institutions 2013. So we see this as a potential area of contention and dispute between the Revenue Authority and the parties operating within that sector. Then again, we are seeing the removal of excise duty on imported glass bottles. So this is an amendment that came through the Business Laws Amendment Act in March 2020. And what it meant was that any person importing glass in Kenya would be required to pay excise duty at the rate of 20%. And this would be collected as part of what is called import duty. So at the point of importation, you'd be required to pay excise duty. And what did this then mean? So it means for the who is importing glass in Kenya from the East African partner states, despite of the fact that, we operate as one customs union, one customs market protocol, And therefore, we operate, within the East African community, anybody importing, with manufacturing and within that region, we enjoy what are called non-tariff barriers. The introduction of excise duty on imported glass meant that you'd have to pay excise duty at the rate of 20%. And so a case was filed by a company in Tanzania, probably the largest importer and exporter of excise duty into the Kenyan market at the East African Court of Justice. And, a stay was obtained and against the implementation or execution of that decision. And perhaps happy to say that actually it's the firm of Anjarwalla Khanna that was represented the taxpayer at the East African Court of Justice. And through the Finance Bill 2021, there's now a proposal to remove excise duty on imported glass. This could perhaps be a reaction, to the stay that was already obtained. And then just moving along, these are some of the other changes we expect to see coming through the Finance Act 2021. So I think, when we have our own time and when we retire, perhaps, we can look at some of those changes that are likely to take place. So for now, I think we'll move on and let's look at some of the changes that are also anticipated to come through the Tax Procedures Act. So by way of an introduction, the Tax Procedures Act came into law in January 2016. And the objective of the Tax Procedures Act was to harmonize all the administrative measures across all the revenue laws. And what were these administrative measures? So previously, the Income Tax Act would have its own provisions on service of notices, fees and interest, issuance of assessments, objections, and etc. Then you'd also then find similar provisions under the VAT Act and under the Excise Duty Act. But through the Tax Procedures Act, there was harmonization of all those administrative provisions governing the tax laws, so that now, if the same penalty that's applicable under the Income Tax Act is the same penalty that will be levied under the Excise Duty Act or the VAT Act, or so the case may be. So the first amendment that we are then seeing is that the definition of what is a tax law and what will be subject to the provisions of the Tax Procedures Act has been expanded. So currently, as it reads, a tax law under the Tax Procedures Act is defined as the Income Tax Act, the VAT Act, the Excise Duty Act, and the Tax Procedures Act itself. But currently, the proposal is to expand this definition to include the Miscellaneous Fees and Levies Act 2016, under which we see imposition of some levies such as the IDF and others. Then the second proposal that we see is the statute of limitation increased from 5 to 7 years. So currently under the Tax Procedures Act, a taxpayer is only required to keep records for a period of 5 years. And then what that means is that the commissioner in raising an assessment can only go back 5 years and not beyond 5 years. Unless, of course, in instances where the commissioner has been able to prove tax evasion or fraud or willful neglect on the part of a taxpayer. Now, under this, through the Finance Bill 2021, what we are then seeing is that there is a proposal to increase that period from 5 to 7 years. And this is what prevailed in some pieces of legislation prior to coming into force of the Tax Procedures Act. So we are seeing a reintroduction of that provision under the TPA, so that then the commissioner will be able, if they start an audit today in 2021, it means the commissioner will be able to go back and audit you all the way back to 2014, so to say. But obviously for now, if this amendment does come through, it can only, be proactive and not, retroactive. And then again, we are seeing a proposal on maintenance of financial records for non-residents. So currently, as it is, all financial records must be kept, must be maintained in Kenya shillings, but we are seeing now an exemption from that requirement for non-resident entities, so that they will be able to keep financial records in a foreign currency that can be converted into Kenya shillings. Then again, we are seeing the grounds for abandonments of taxes widened. So currently under Section 37 of the Tax Procedures Act, the Commissioner may grant relief from recovery of tax, where in the Commissioner's view, it is impossible to collect the tax, or where it would be too costly to do so, or where a taxpayer has been able to demonstrate hardship or inequity. And of course, in this instance, a taxpayer would most likely have to demonstrate financial hardship and inability to pay the entire tax or part of the tax assessed. So we are then seeing a broadening of this, of the conditions to then include any other reason occasioning inability to recover and pay tax. We are then seeing another condition, and this is obviously for the Commissioner, where the Commissioner then would be required to submit to the CS biannually a report or status of the details and amounts of tax abandoned for purposes of just enhancing accountability and transparency on the amounts abandoned. Then again, we are seeing the repeal of the tax amnesty on rental income. Most of us remember that a few years ago, KRA set up a task force and also extended a tax amnesty on payments of income. This is just a cleanup. I think that provision has been in the law, although it had been overtaken by events. So I think the proposal is then to repeal Section 37A of the TPA. Then we are then seeing elimination of withholding tax exemption for suppliers with the perpetual credits. And maybe, before I proceed, I can ask my colleague George to just give a bit of information on that issue.
Yeah, thank you. Thank you for that, Wangui. On this issue, I think the point we're seeing is that in 2020, there was an introduction of an exemption from withholding VAT for certain taxpayers who are in a perpetual VAT credit. And basically, a taxpayer who finds themselves in a perpetual VAT credit will be someone involved maybe in export of services, meaning that their supply is zero rated. So, and these are the people who, again, due to their perpetual credit position, they now proceed to also make application for refund of some of this VAT. So the impact of withholding VAT that has been seen in the last few years has been that this withholding VAT again increases the VAT credit, because their suppliers, before they are paid, people will their purchasers will withhold the 2% and pay that to KRA. So what this results in a situation where they already have their input VAT credit, and then this is again added up using by the withholding VAT credit. So this provision, last year there was a provision to just exempt them, to just ensure that the cash flow is managed better. Their cash flow is managed better. Now, what we are seeing as a proposal right now is to just delete this, and what this means is that now all taxpayers, whether you are in a perpetual VAT credit, you'll end up having to still be subject to withholding VAT. Again, thinking about the other changes we saw with regard to VAT in terms of changing exported services to exempt, probably are aligned also to this, but these are things that we hope in the submissions that the public is putting together, we'll just suggest or provide to the Treasury that the exemption be retained to ensure that cash flow issues are managed, especially in the middle of the COVID-19 pandemic. The other issue that maybe I'd want to touch on before handing back over to Wangoi is on the issue of offsetting tax liabilities against verified refunds. Again, this is just a clarification on how refund of overpaid tax can be applied to tax due. So in this case, how this works is where a taxpayer has an assessment of tax. So basically, KRA assesses that you owe an amount to them. But then on the other hand, you also have applied for a refund of overpaid tax. What this provision seeks to clarify is that the moment KRA approves your application of the refund to the amount owed to them, then interest will not continue to accrue from that date going forward. Again, I think for this, it will make more sense to have the interest to stop accruing from the date the refund is paid. The overpayment is made by the taxpayer, but this now just clarifies that the interest stops to accrue on the date that basically the KRA approves that a refund is due to you, and it will be applied to your tax assessment. Over to you. I'm going to just proceed on the next one.
Okay, thanks for that, George. And then again, the due date proposes then to also allow for electronic submission of objections and returns over the weekend. And currently, as it is, if your due date for doing something falls on a public holiday or a weekend, we then fall back to the provisions of Section 2 of the Interpretation and General Provisions Act, so that what becomes a working day will be the next working day after the public holiday or the weekend. But currently, the law then proposes to then provide that when a notice of objection falls due on a Saturday, Sunday, or public holiday, then the due date is taken then the due date is taken to be, the following working day. But then now the law is proposing to amend so that that day will also be good for filing. So I think then this requires us then as taxpayers, or if we're advising for us to be very, very vigilant, just to ensure that if it then falls on the following working day, you most likely will be deemed to then have filed your return, your objection out of time. So I think this is one provision that you may really, again, may want to lobby, and we expect that there'll be a lot of lobbying around this. Then again, there's a provision then to protect the KRA officers acting in good faith from being personally liable for any acts of or omissions done or committed in performing their functions under a tax law. And then currently, again, where you're facing both a criminal and civil proceedings on the same tax dispute, and this is very common. You may have, a tax assessment, and the law requires you to assessment in a certain manner, and the statutory timelines for that are very stringent. Then in another instance, you may then have criminal proceedings which have been instituted against you. And in terms of practice, what we tend to see is that you might stay the civil proceedings so that you conclude the criminal proceedings. So again, the bill proposes that there shall be no stay of proceedings, or either of the proceedings, and then both of them will run concurrently. So I don't know how this will play out, because in certain instances there is the risk that what you're pursuing in the criminal proceedings is likely to impact the eventual outcome in the civil proceedings. So I think this is another area that that I think parties really need to lobby. Then we're also seeing, now, any person trading in the digital marketplace will be required to lobby will be required to register for PIN. Then what we are seeing is the commissioner then in terms of GSP will be empowered to seek the intervention of a relevant authority in the collection of tax, where a person provides services through the digital marketplace. However, the term relevant authority is not defined. And then I will now hand over to my colleague Dennis, who will then take us through the changes we expect to see in the Miscellaneous Fees and Levies Act. Thank you.
Thank you, Wangui. So relating to the exemptions that have been deleted on the Finance Bill 2020 and Tax Laws Amendment 2020, the Finance Bill 2021 now proposes to reintroduce the exemption relating to IDF and RDL on importation of equipment that the Cabinet Secretary may determine to be in the public interest. So previously, this exemption was used by power companies or other high value capital investors to seek exemption relating to IDF and RDL. And most of these investors were manufacturers in various, various sectors, and also high capital investors such as the power energy sectors. But interestingly is that even though this exemption has been introduced, the investment has to be over 5 billion, and previously it was 200 million. So we like to see how this will pan out, because some of the investments may not reach to that level, and therefore the exemption may beat the purpose. Various other minor amendments relating to IDF and RDL is currently the MFL, the Miscellaneous Fees and Levies Act, does not provide for refund of fees and levies, because this act fund or these fees and levies were previously handled through the East African Custom Management Act, and therefore some of these issues of refunds are being handled through it. But now the bill seeks to align that so that these proposals on refund, etc. can now be handled through the Miscellaneous Fees and Levies Act. And therefore, you can now be able to, if the proposed amendment is approved, you can be able now to make an application within 5 years and also get your refund within 2 years. So the KRA is under obligation to give you the refund within 2 years. If it does not, then 1% interest per month will start accruing to KRA, and therefore these are a very welcome move in terms of aligning the procedural issues relating to the refund. Thank you so much. So that's it in terms of the key salient changes. There are other minor changes which you have not covered, but these are the key changes that you need to look out up to. And now we can be able to take questions that have been raised by the members.
All right, thank you very much.
So thank you very much. I think we've come to the end of the presentation. So would like to really invite questions. I think we can only see one question in the chat box, so I don't know whether we've managed to confuse you. But I think now is time for the Q&A questions. And yes, as a team, we're ready to take questions. And just to also just say, I know we have other members of the A&K on this call. And so maybe just to introduce Kenji Gruner, who's a partner in the A&K tax team. I don't know, Ken, are you still with us? And if you could just
I am
say
on way.
hello.
Thank you. Thank you very much, and good afternoon, everyone. Nothing really much from you, Wangui, but of course, if many questions come up, happy to assist with that.
All right, thank you, Ken. So I think let's start with the first question. So the first question is Parliament likely to pass these proposals wholesale, or is there a possibility of major amendments? I think all I can say as regards this is that obviously, before they can pass these amendments, obviously, there will be invitation for public participation. And what that then allows stakeholders is then to put in submissions, on the provisions, just put in some lobby efforts. We expect there'll be a lot of lobby efforts around some of these provisions. So it is unlikely that the finance bill will be passed wholesale. I think we will see some amendments, but how major they will be, I think it's too early to say. But I think what's the greater the lobby efforts are, from as many stakeholders as possible, I think then the high likelihood, that we are then likely to see hopefully some major changes. I think, Stephen, I don't know whether that answers your question. Saini? Okay.
Sorry, Wangui, yes. Thanks, it does.
Okay. So we then have another question, whether there's a requirement for concurrence by the Senate, given some of the proposals affect county governments. I think I can throw this to some of my team members. Ken, would you like to take that?
The question here is whether we need concurrence as between
the two houses.
The two houses. Good question. Traditionally, what we've seen is the finance bill will only go through Parliament, and we've not seen being tabled before the Senate. That's a good question. I don't think I'd have an immediate answer to this, but in all past years, we've only seen this go to Parliament, the National Assembly. But I don't know what proposals this will be that affects county governments in the finance bill. I'll not see any which would particularly affect a particular county or so, unless there's something that Stephen you've picked up.
I think I saw something on sugar, some of the excise duties. Yes, some of them, some of the products are maybe county specific, but it's a general question.
Okay, so maybe just to follow up onto Ken's response. Obviously, I think is it last year we saw a number of acts, including I think the Finance Act of 2018, which were declared unconstitutional by the High Court because of having not gone through the Senate. So I believe then if there are some provisions that will affect county governments, then yes, there's a likelihood then if it doesn't go through that process, then there is the risk that then they may be declared unconstitutional. But obviously, if there is a challenge on the unconstitutionality of those provisions, but I think even when we are talking about the sugar, I think the sugar related to the locally imported sugar confectionery and chocolates. So those will ordinarily be your sweets and things like that. So I think that becomes more national issue rather than a county issue. But I think it's food for thought. Saini, I don't know if we've been able to answer you.
You have, actually, it's food for thought. Yeah. We need to.
Then I see there's a question that's been directed to me, and and it reads, you mentioned that the tax litigation space is one that is extremely active as of late. We understand that the context behind this is the heavy measures on revenue collection and that the government is imposing on KRA. with your experience, what merit is there to the disputes KRA is bringing to the TAT and appealing to the superior courts? That's that's a good question. And then, is KRA winning them, or are they just shooting in the dark and frustrating taxpayers? What injustices, if any, have you seen being occasioned to taxpayers amidst this highly litigious environment, and what has been the success rate for tax disputes that go into KRA's ADR program? So let me start with the latter question. I think the ADR program has been a great success, and especially now and more recently, we are seeing a lot of willingness for KRA to take disputes out of courts and the Tax Appeals Tribunal and bring them to the ADR process. In fact, previously it was only taxpayers that would be appealing decisions to that would be applying to have disputes resolved to the ADR process. But more recently, and in the last 12 months or so, we are actually seeing KRA being the person to initiate the ADR process, which is definitely a welcome move. I don't have the statistics, in terms of the, the cases that have been closed through ADR process, but I think we can say as a firm and from experience, we are experiencing a lot of success in closing disputes through the ADR process. And usually as a strategy, what we tend to encourage, even if we have disputes at the TAT and the High Court, because of the benefits that accrue through the ADR process, we usually will always advise our taxpayers, unless it's an issue involving an issue of strict interpretation of the law, let's go and see if we can resolve this through the ADR process. And because obviously a lot of taxpayers, yes, they want to litigate and just, and get issues right, but they also want to be able to do away with disputes and continue with their businesses. And also, remember that a lot of these taxes, as we are litigating, lie as contingent liabilities in their books. So a lot of taxpayers we are seeing are also very willing, if you're able to explain to them the benefits of the ADR process, to engage in this process. So I think it is successful, and we are seeing a lot of willingness from KRA. Now, in terms of the merits of the disputes or assessments that we see KRA generating, which then become disputes, I think we could say that there's a fair balance. I can't give you the exact statistics, but yes, there are instances, even, we are like, with all due respect to KRA, we're shooting in the dark. We don't even know where you're going with this. But, to be fair to them, there are instances where there's merit in what they are really saying. And in terms of the win, I think it's difficult to say. Maybe it's because in the media, KRA is very good at to publish their wins, whereas taxpayers may not want that negative publicity, associated with publicity. But I would like to also just say, I think, I don't have the exact percentages, but I would like to say that, taxpayers are also having their days at, their day at the TAT and the High Court. I don't know, Abdullahi, whether I've been able to answer your question.
Yes, you have. Thanks, Andre.
Okay. Okay. Yeah.
I think I'll take the next questions. I see this participant who's asked a question on DST and registration of DST. The question reads, how will government implement the digital services tax, especially on businesses that do not have a KRA PIN? So what happened with the introduction of DST in the Income Tax Act and the VAT Act? Subsequent regulations were passed that extended the administration of DST in Kenya. And for resident companies, it was a matter of you already have a PIN, you're just adding an obligation, an additional obligation called income tax DST, for instance, to be able to comply. And income tax DST came into force on the 1st of January, while VAT on digital market supplies came into force in April. So for non-resident persons who do not have PIN, and I think this is what your question, Anastasia, is directed to, the regulations provided for a simplified registration mechanism where you register a PIN and you only account for income tax DST. And come April, you just add an obligation for VAT. So this did not require you to disclose any other additional information. In fact, the filing regime currently is very simplified. It's sort of making a payment. So you just, by the 20th, you go to your PIN, you input the amount that is due. So you input the revenue generated from DST supplies or digital services, and then automatically the system computes the percentage and shows you the tax due. And so is VAT. So at the moment, the registration and the compliance burden, especially for non-residents, is extremely simplified. And we have seen some good amount of compliance from multinationals who are carrying out businesses in Kenya without having a PE in Kenya. Additionally, to point is also the fact that there is no requirement to do a detailed return. So it is quite straightforward. And also the law allows where non-resident persons who don't have a P in Kenya, because the application of DST exempted people from having been deemed to create a P in Kenya. So the law also allows such non-resident persons to use tax representatives. So you can appoint a tax agent in Kenya who will take up the filing and compliance burden on your behalf. So we'll go to also address the second question. I hope I have answered your question, Anastasia. So I'll also address the question from Lucy. She says she missed a bit of the thin cap presentation. Lucy, what the bill proposes to do is to amend the current regime of thin capitalization. So how thin cap works, just to recap, is for companies that are foreign controlled and they are using debt financing. And the reason that we have thin cap rules is so as to sort of encourage long-term and permanent investment in Kenya through equity, because with debt financing, there's a lot of capital risk, because you can always recover your money through interest, and you can always, get out as an investor through repayment of the loan. So the thin cap provisions were to just slightly make it more punitive to invest through debt. And currently the thin cap is computed on a ratio basis, which is 3:1 for all the companies that are debt funded and are controlled by foreign entities, and 2:1 for companies in the extractive petroleum mining sector. So what the bill proposes to do is to change that basis of computation by introducing what you call the Ebitda method. So the Ebitda method will consider a percentage, which is 30% of the company's earnings before interest, tax, depreciation, amortization, and also excluding any income that is exempt from tax. So what you would do typically is you take your profit before tax from your tax computation, and then now you add back, you introduce back the interest, you introduce back any depreciation or amortization, and you remove the exempt income. So once you have that figure that you call EBITDA, you do a 30% straight line, ratio. So you say 30% of EBITDA, it gives you a figure X. So if the interest that you have incurred from the loans is higher than the figure X, then the amount that is higher than that figure X is not allowed. So what we have seen is this Ebitda method is very punitive, because especially, for instance, if you have exempt income, then you have lowered your EBITDA. So you have sort of lowered the thin cap ratio. So anything above that EBITDA is restricted. Additionally, we see that this thin cap method also proposes to include in the computation of interest any expenses incurred in raising capital or anything that can be deemed as an expense. So it sort of increases what would ordinarily be allowed, because generally interest expenses is an allowed business expense. It sort of increases what would be restricted or allowed, as the case may be, based on your thin cap ratio. I hope I have addressed your question on thin cap. And then there's another question on the KRA pressure to collect revenues, and how does the government balance the interest of local and foreign investors in the enforcement of this tax legislation? Okay, so that question has been addressed by Wangoi. So there's another question. My colleague Dennis is going to address the question on minimum tax. General question for the panelists. Any thoughts on the proposal by President Biden to have a global minimum tax rate? Are there any indications that the UK will support such a proposal?
Thank you, Koi. That's a very interesting question, because you have seen the government trying to introduce minimum tax in Kenya, which has faced in terms of court dispute, etc. And I mean, we also seen news through the US where Biden is also proposing minimum tax, especially for entities that have revenue above a certain threshold. It's a very good proposal, but I mean, at this point, from a Kenyan perspective, I think we'll wait to see how these will pan out and see whether there will be any resistance, especially with the high net worth multinationals. But from a Kenyan perspective at the moment, I think there's some form of reluctance, especially from the public in terms of application of minimum tax. So I think this is open to, we wait to see how things will pan out in the next couple of months. Alex, I think this is the last question. We hand over the session to you.
All right, thank you very much, Dennis and team. At this point, my role is generally to thank you all for attending, and especially to thank the team from Anjarwalla and Khanna for the wonderful presentation that you've made. As I mentioned at the beginning, we hope to do more of these sessions as the months go by, and these will be initiatives of the Tax Liaison Committee. We welcome any contributions you may have on any topics you particularly want to be covered, and this can be sent to the Nairobi Branch Secretariat. And we'll be able to discuss this at our, at the committee level, and then see how we can bring this to you. So thank you very much, everyone, for attending. Thank you very much, Wangoi and team. It's been very enlightening. I mean, tax issues cut across, cut across the country. Everybody is affected by tax, and it's good to see these things come to the fore. And so that said, I'd like to close the session, and we'll be able to send this presentation to you. And thank you very much for attending. That would be all from me. Yeah.
Thank you.
Thank you, everyone.
Bye.
All right. Bye.
Thank you.